Thanks so much for tuning into this very special conversation with a very special guest. As he tells me, he's come to India after a period of 3 years. So it'll be lovely to understand his observations on around the world, and more importantly, how does he feel about the trip as well. Jahangir, so good having you. Thank you for joining in.
Thanks for inviting me.
No, the pleasure is entirely ours. How does it feel?
Look, 3 years is a long time. The world has completely changed since the last time I was here, which was probably around December 2019. I think, the pandemic, the Ukraine war, I think both of them probably, so far we have looked at these two things more or less in terms of very short-term dynamics, in terms of is the pandemic's impact on inflation, on demand, on growth, Ukraine war's impact on commodity prices. I think these are very near-term, short-term impact. I think both of them are probably going to leave behind scars that we will probably have to work through in the medium term. And I would say particularly the Ukraine war. I think that essentially has not only changed geopolitics, but I think it's also changed the manner in which global supply chains get relocated, especially in emergent technologies.
So in your answer, one is a hypothesis and one is your knowledge of the actual on-ground displacements that have already happened.
Right.
Since you're laying so much of emphasis on the Ukraine war, let me kind of focus on that.
Sure.
What is the near-term and the medium-term impact, actual and hypothetical, that you are penciling in currently?
So the actual is pretty clear, right? We saw the first half. So we come into 2022 with already elevated commodity prices, and that elevated commodity prices was on the back of a very strong post-pandemic demand recovery that was taking place. In addition to that, across the commodity space, doesn't matter whether it's oil or it's something else, there hasn't been any material increase in supply and capacity over the long period of time, right? So we were going through a period in which there was a spike in demand and everything was in short supply. So obviously that got felt in commodity prices. The Ukraine war worsened it. Ukraine and Russia were critical suppliers of not just food, but a whole bunch of industrial metals apart from, oil. I think that's the way in which the world has looked at it. But also the unified manner in which US and Europe pushed those sanctions. And, now they're pushing for caps on oil prices that's going to be exported out of Russia, etc. I think that has a lesson that I think other emerging market countries and other countries will take much more seriously. So if you go back to an April speech by Janet Yellen, where she openly talks about the fact that under the previous or the existing trade arrangement, and she calls it she doesn't call it, other people call it Bretton Woods 1.0, the belief was that free trade and free capital movements, right, would bring together all countries under the same, again, for the lack of a better description, neoliberal democracies, right? But she made that very clear that it hasn't happened. Yeah. And consequently, they're looking for a trading arrangement where it is not that we do free trade and free trade impacts politics globally, but the other way around, where you do trade within the circle of trust. Mm-hmm. And I think if that's the attitude that they are going for, or that's the process which they're going for, then I think the kind of calculus that you and I and everybody else would make about where would supply chains locate based on commercial reasons, where you get skilled labor, where skilled labor is reasonably, cheap, yeah, where you have infrastructure, where you have predictability of policies, then that list of countries, where a bunch of countries that we all talk about would be there, wouldn't necessarily be in the list in which you're telling me that the supply chain has to get relocated in the circle of trust. Mm. So I think that if the relocation happens, the way we would think about relocation before the Ukraine war, I think that needs to change global supply chains most likely will get relocated, and offshore will be replaced by what is now called friendshoring.
Wow, yeah.
And friendshoring and offshoring are two different things.
India might be well placed, and I'll come to that in a moment. But just before we do that, just a couple of follow-ups on this global piece that you spoke about. A few people have gone so far as to say that the gas price issue could well turn out to be Europe's Lehman moment. And some people differ. They're like, it won't be as bad. What's your thought?
I think that if you went back and asked that question in June, more people would have agreed to that. But look at what has happened after June. So, Nord Stream 1 pipeline has been shut off for longer than what people had expected. And prices of European gas went through the roof. But as a result of that, the Europeans started importing an enormous amount of LNG. So LNG imports started rising. And so estimates suggest that they are about 85-90% of the reserves that they normally would have for winter. They already have that. So I think the impact on rationing, etc., most likely is going to be less severe than what one had feared was going to happen in June, July, if winter is normal and it's not a bitter winter. I think that's one thing. The other thing is that people hadn't really expected, Europe to provide fiscal support. Europe has been very, very miserly in terms of providing. This is not the United States where, you increase fiscal deficit to 8-9% of GDP. They've been very miserly, but that's not what's happened so far. Led by UK, and I know that UK does not say very much about Europe, but if you look at UK's fiscal support that's come out, it's substantial. And already Europe is talking about reasonably large fiscal support. So if you provide the kind of fiscal support and you do not have to do severe rationing, my sense is that you will still get a recession in the fourth quarter and the first quarter, but it's likely to be much more shallow than what normally people would have feared back in June, July, when that question was, pretty much in a lot of people's minds.
Jahangir, you have experienced more than a lot of others, certainly me. I'm just trying to understand from your perspective, how do risk assets fare in the light of conversations around recession? Because clearly they are not too bothered about it. And more importantly, the new world order of withdrawal of liquidity, right? In the first time in so many decades. How do you look at it?
So I think, there's a part and parcel of regular conversation, and it's a pretty global conversation, is people worried about a slowdown. But just look at the world between the first half of 2022 and the second half of 2020. In the first half of 2022, the largest economy in the world, US, had an annualized growth of minus 1.2%. The second largest economy in the world, called China, had a minus 0.5% annualized rate. Now, whatever concerns you have about COVID, zero COVID policy in China and continued lockdown, etc., in 22 second half, China is going to post a higher growth rate than in the first half. And the largest economy in the world, US, is also going to post a higher growth rate in the second half. So roughly 50% of the global economy is going to grow stronger in the second half of the year. Europe will go through a bad time, but estimates are becoming, as you spoke about, shallower and shallower recession rather than deeper and deeper recession, given that fiscal policy has been brought to the forefront. Then there is the rest of the world, which is emerging market ex-China, and clearly there's a slowdown, and the slowdown over there in the second half of the year is going to be in Latin America and Europe, largely because Latin America and Europe are now going to pay the price of the massive monetary tightening that they did. Monetary tightening takes 6 to 9 months to have an impact, and that's when we feel that the impact is going to be felt. Asian emerging market ex-China isn't going to do that badly, probably depends on how much China, but probably going to scrape through with a reasonable amount of growth. So the world isn't really going into recession and slowing down as yet.
Okay.
But that's not very good news, and I'm going to come to asset market. It means that the central banks are not going to start easing anytime soon. In fact, there's a central bank called the Fed next week, this week.
This week.
Yeah. Probably going to come up with a, hawkish tone, and not only hawkish tone about hawkish action, but a hawkish tone. ECB, if the recession is not shallow, ECB is going to likely to continue to raise rates. If you have, that amount of fiscal expansion taking place in UK, Bank of England is probably going to keep on raising rates. And the impact of all of that is going to be felt by emerging markets who so far, particularly in Asia, who so far haven't really raised rates very much, will be pushed into raising rates. We'll see what happens, what RBI does. So my point is that risk assets are now looking at, recession fears would have led to, recession fears will lead to central banks easing. Recession fears are fading, at least for 2022. Maybe in some point in time it will come back again, which means that the central banks are going to probably be much tighter. And there isn't any rate cuts and things like that people were expecting. So I think asset prices, both the equity side and the bonds and bond prices, will have to react to that. And I think that so far the market doesn't look as if, at least not the bond market, not the equity market, doesn't seem to getting that there is no recession implies that rates are going to be tighter, and what it does that to equity prices. Bond markets so far, I know the 10-year has moved up in the last couple of weeks' time. The curve is still inverted. So yes, the bond market is probably accepting the fact that probably the recession is not going to happen immediately. And I think the bond market very quickly will also start pricing in that there isn't any rate cuts in 2023. I think, this week we will get to know how the FOMC indicates in that direction. But that's the way we are looking at it.
So you reckon the FOMC could do 75 or 100 and sound very hawkish?
So we think that they will do 75. 100 would be out of character. But having said that, they have been out of character in the last three FOMCs. But our baseline is that they'll do 75. But that's not the important part. The important part is, what do they indicate about November? What do they indicate about December? And what do the dots say about 2023? If the dots move up in a substantial manner, if they indicate that they will remain at the same pace in November, I think that's the part that the market, I don't think, is pricing in. I think parts of the market are pricing in probably 100. Most of the market is probably pricing in 75. That is not going to be the surprise. Our sense is that what the market is not pricing in is what they indicate or what guidance they provide. They don't provide any more guidance any longer. But what do they indicate is going to happen in November, December, and more importantly, in 2023? And I think market will probably be surprised on the hawkish side rather than the dovish side.
Okay. My final question. India within this puzzle, simply because we've fared well thus far.
Sure.
I wonder if, because India looks so good in a geopolitically divided world, if things were to resolve themselves, would India start looking less attractive because then everything else starts looking normal? What's your sense?
So I think, there is a debate, let's say, about monetary policy right now, right? Whether should go 35 or 50 or where the terminal rate is. There is this usual debate about trade-offs between growth and inflation. My guess is that that trade-off is false. And the reason why it's false is because that is not where RBI policy or macro policy more generally should be focused on right now. And I'm focusing only on macro policy, not on reforms. Should we focus on? While we are all debating about whether inflation is the problem or growth is the problem, look at what's happened to our old problem, which has always been India's Achilles heel, the twin deficits. State and central deficits probably going to hit 11.5%, 12% of GDP. But far more worrying is the fact that current account is hitting at 4% of GDP. The last time when we had this combination, it was back in 2013. There, a whisper that the Fed would tighten monetary policy created the taper tantrum. The Fed now is doing QT and is raising rates. So I think macro policies, particularly monetary policy, and clearly next year's fiscal policy or fiscal policy for the rest of the year, should not get sidetracked into worrying about growth versus inflation. That is not India's problem right now. India's problem right now is to ensure that there is macroeconomic stability, because we have reached that point where traditionally India becomes very vulnerable. When you go beyond that 2.5–3% of current account deficit, when you go into double digits of fiscal deficit, and as proof of the pudding, in what RBI has already intervened, what, $80-odd billion? Again, you can point to massive amounts, levels of FX reserves, but it's not the level that matters as much as the burn rate that matters. And already people are talking about, well, should the RBI be wasting money in defending the currency? My point is that it is macroeconomic stability that needs to govern what RBI plans to do and what the government plans to do on the fiscal policy, rather than this thing about growth inflation trade-off, which right now is sort of meaningless and probably false.
So sorry, I know I mentioned last question, but I will squeeze in just one quick more. What would you have the Reserve Bank do over the course of the next 6 months with the hypothesis that you have around what will happen around the world?
I think RBI, despite the fact that you haven't really seen very much credit growth. Credit growth in real terms is barely skating water. Nominal terms has moved up, but hasn't done very much. Regardless of that, I think that RBI needs to raise rates, and needs to raise rates probably more aggressively than they have in mind. Probably more, I believe that RBI has been talking about front-loading. I'm not exactly sure what front-loading means in this context. But I think the RBI needs to signal that they are worried about the current account. They are worried about what is happening to the fiscal deficit. And they're worried about the fact that, global financial conditions are not only have tightened, but most likely it's going to tighten further. And if euro area growth is going to weaken, whereas US growth is going to lift off or do better, and the growth differential between Fed and ECB is going to widen, then chances are that we're also going to see a further strengthening of the dollar. That's not a very good world for India. And I think that's what the RBI should do. Talk about that and therefore raise rates.
Okay, well, I'm sure the Reserve Bank governor is listening to this as well. But Jahangir Aziz, always a pleasure talking to you. Thank you so much.
Thanks very much
for being on our platform. No, really pleasure talking to you. Viewers, thanks for tuning in today.